Okay, are you maybe wrestling right now with one of those really big decisions about your money? Thinking about maybe opening a new account or, just wondering if the place where you keep your cash is actually the best spot for you.
It's a common question.
Yeah, it feels like this simple fork in the road, right?
Yep.
Bank or credit union. But looking through this stack of sources we've got, when you dive just a little bit below the surface, wow,
Yeah.
you find some really fascinating differences. Structural, financial, philosophical even. And they could really impact your financial life in, well, some pretty surprising ways.
Absolutely. I mean, think about it. For most people, their main bank or credit union, it's something they deal with constantly, maybe even every day.
Right.
So choosing between them isn't just, picking a logo on a card. It's really choosing a whole business model,
Uh-huh.
a fee structure, how they approach lending, maybe even the kind of server that you're going to get, understanding these, core distinctions, pulling back the curtain on how they work and why.
Yeah.
Well, it's not just academic. The sources really show it translates directly into, real-world impacts. Saving money on fees, earning a bit more on your savings, maybe getting a better rate on that next car, or even your mortgage.
That's exactly right. So today, we're taking that deep dive. We've got this great stack of sources you pulled together, articles, research reports, consumer studies, all comparing credit unions and banks right here in the U.S.
Yep.
Our mission, really, is to unpack the most critical differences laid out in all this material. We want to zero in on the data, especially around fees and interest rates.
Key points.
Yeah, and explore how their fundamental operational models actually play out in the real world for you. And ultimately help you figure out what all this means for your specific financial journey, your priorities. We're going to try and cut through the marketing noise here.
Yeah, get to the core of it. Our goal is basically to be your guides through this pile of information, pull out the most important nuggets so you can weigh what really matters when you're making this choice.
Like the Cliff Notes, but with context.
Exactly. Cliff notes with a bit of analysis to make it actually useful.
Okay, let's unpack this then. Starting with, I think, the absolute foundation. The sources just keep coming back to this one key difference between a bank and a credit union. It's the thing that underpins everything else, and it's simply who owns them and why they even exist.
This is it. This is the bedrock difference. If you get this one thing, the rest of the comparison just makes so much more sense. Banks. Okay. At their core, they are for-profit organizations.
Right.
They're owned by shareholders. Now, these could be big investment firms, individual investors, maybe even you, if you own stock in a publicly traded bank. The primary goal, the main driver for a bank, is to generate profits for those shareholders. Every single decision they make, setting interest rates, charging fees, developing new products, it's ultimately shaped by this need to maximize shareholder value.
So the money the bank makes isn't necessarily staying within the bank just to benefit the customers. A big chunk of it is heading out to the owners, the shareholders.
Precisely. Think of it just like any other company listed on the stock market. They want to boost their stock price, pay out dividends. Profitability is the name of the game.
Yep.
Now, contrast that with credit unions. Totally different setup. Credit unions are structured as not-for-profit cooperatives.
Not-for-profit? Cooperative.
Yeah, it's a fundamentally different model. They aren't owned by outside shareholders hunting for profits. They're owned by their members.
And the members are?
The members are the people who use the credit union. The account holders, the borrowers, the folks who walk in the door or use the app, they are the owners.
Okay, wait. So the customers are the owners in a credit union. That sounds like it changes the whole dynamic.
It changes absolutely everything. Because there are no external shareholders demanding bigger and bigger profits, the credit union's mission just completely shifts.
How so?
Their purpose isn't to squeeze out maximum profit, it's to serve the financial needs and interests of their member owners. So any money they bring in beyond what it costs to run the place, it isn't paid out as profit to outsiders.
Right.
It gets reinvested back into the credit union itself, or it's returned to the members in different ways.
Reinvested how, though? What does that look like for me if I'm a member?
Well, typically that reinvestment shows up as, say, lower fees compared to banks, or maybe slightly higher interest rates on your savings accounts or CDs.
Okay.
And crucially, lower interest rates when you borrow money, like for a car or a home. They also put money back into improving services, maybe upgrading their tech, sometimes offering things like free financial education workshops. And here's another key part. Because you're an owner as a member, you often actually get a say in how the place is run.
Really? How?
Yeah, many credit unions hold annual meetings. Members can actually vote for the board of directors, sometimes even weigh in on important policies. It's this member-centric approach, this direct alignment, between the institution and the people who actually use it. That's the absolute defining feature. It's service to the members, not profit for shareholders. That's supposed to be number one.
That distinction is just. It's really stark when you lay it out like that. One is basically legally obligated to maximize shareholder return, and the other is built to prioritize the financial health of the people banking there.
Exactly. That's the core difference.
Okay, so let's translate this big foundational difference into something really tangible, something that hits everyone's wallet. Fees. This feels like where that ownership model would show up right away.
Oh, absolutely. Fees are a major, major point of comparison in all the sources we looked at. And they consistently show that the not-for-profit member-owned structure of credit unions generally means lower costs for you, the consumer.
Because they don't need to squeeze out fee income for shareholders.
Precisely. They aren't under that same intense pressure to maximize what's called non-interest income, which is basically fee income. So they have more flexibility to keep fees lower or maybe make them easier to avoid altogether.
Can you give us some specific examples from the data? Where do these differences really pop?
Sure. The sources highlight a few key areas pretty consistently. You often see banks charging higher fees for things like wire transfers or maybe stopping a payment on a check.
Right.
And perhaps the most noticeable one is overdraft fees or non-sufficient fund fees, NSF fees. Credit unions pretty much across the board tend to charge less for these kinds of services.
Let's dig into those overdraft fees a bit more. Because, man, that's an area where a lot of people get hit, and it can feel really punitive sometimes.
It absolutely can feel that way. And the sources give us some pretty compelling data here. Research shows a clear difference. On average, credit unions charge nearly $3 less for an NSF fee compared to banks.
$3 less?
Yep. The average NSF fee at credit unions was cited around $28.08 in one study, while at banks it was closer to $30.81.
Okay, so $3. Per instance, that might not sound like a life-changing amount of money, but you mentioned research on how often people overdraw.
Right, and that's where the impact really multiplies. One source we looked at mentioned that tens of millions of Americans overdraw their checking accounts every single year. Some estimates put it over 40 million people.
Wow.
So think about it. If even just a fraction of those overdrafts happen at that lower credit union rate, that $3 difference per transaction adds up to millions, maybe even billions of dollars saved by consumers across the country every year.
Billions, just from that $3 difference.
Yeah. An expert quoted in one of the sources pointed out that even just a $1 reduction in the average overdraft fee across the entire industry would save consumers huge sums. So $3 is actually pretty significant when you look at the big picture.
And it's not just the sticker price of the fee itself, is it? The sources also mentioned something about how the policies around overdrafts can differ.
That's a really crucial point and often overlooked. The fee amount is important, sure, but when and how those fees get triggered can vary a lot between institutions. Because they're member-focused, credit unions might have policies that are a little more lenient. Maybe they offer a small overdraft cushion before any fee kicks in.
Like a grace amount.
Exactly. Or maybe they give you a grace period, like until the end of the day, to deposit funds and cover the overdrawn amount before they charge you. Or sometimes it's about how they process transactions, maybe in an order that's less likely to trigger multiple fees from just one mistake.
Ah, right. The ordering makes a huge difference.
It really can. Banks, on the other hand, driven by that fee revenue goal, might have policies designed, perhaps intentionally, to maximize the number of times fees are charged. It really comes back to the philosophy behind the fee structure.
So the potential savings aren't just the fee amount itself, but maybe incurring fewer fees in the first place because the rules are different. What about the total picture? Like over a whole year, is there data on the total cost of fees?
Yes, there is. And this is where the difference becomes even more dramatic, according to the research we reviewed. One comprehensive study, which actually analyzed real checking account statements, found a really stark contrast in the total annual checking fees paid by credit union members versus bank customers.
Okay, what did it find?
Credit union members, on average, paid only $72 in total checking fees over an entire year.
$72, okay.
Bank customers during the same period racked up an annual average of $183 in total checking fees.
Wow. $183 versus $72. That's, what, $111 difference per year on average?
Yep.
Think about what you could do with an extra $100. That's almost double the cost just for having a checking account at a bank based on that data.
Exactly. It's a pretty significant saving, and it compounds year after year. And here's the part from that same research that I found particularly striking. It really highlights the member benefit.
Well,
Credit union members who had low balance accounts, accounts that maybe frequently dipped below typical minimum balance requirements, they actually paid less in total annual checking fees.
less than who?
They paid less, that $72 average, than bank customers who had high balance accounts.
Wait, hold on. Let me make sure I heard that right. Someone keeping less money in their credit union account pays less in fees over the year than someone keeping more money in their bank account. That seems backwards.
It does, doesn't it? It feels counterintuitive. But it powerfully illustrates that point about the credit union's mission. They're just less reliant on fees as a primary way to make money, and they're structured to benefit the members, even members who might not maintain huge balances. That little data nugget from the sources, for me, is one of the most compelling arguments for the credit union model if minimizing fees is your top priority.
That's incredible. Just incredible. Okay, so beyond overdrafts and the total annual checking fees, what other kinds of fees did the sources suggest people compare when they're looking?
Well, you definitely want to look at monthly maintenance fees. Although it's really important to note, both banks and credit unions often have ways you can get those waived.
Right, like direct deposit or keeping a minimum balance.
Exactly. Setting up direct deposit is a common one. Maintaining a minimum daily balance or maybe an average monthly balance, and those dollar amounts can vary wildly, so you have to check. Or sometimes meeting certain requirements for debit card use or other transactions. It's crucial to check the specific waiver requirements for any account you're considering.
Got it. What else?
Other fees to keep an eye on are ATM fees, especially the fees for using machines outside your institution's network. Although many credit unions have ways to mitigate that through networks, which I think we'll get to.
Okay.
Foreign transaction fees if you travel and use your card internationally. Fees for replacing a lost debit card. And even costs tied to loans. One source specifically called out mortgage closing costs.
Closing costs.
Yeah, they tended to be lower at credit unions. The source cited an average around $1,151 at a credit union compared to $11,361 at a bank. Again, it's a couple $100 difference, but hey, it adds up, especially when you're already spending a lot on a house.
No kidding. So, okay, on the fee front, the evidence from these sources seems really strong. It looks like credit unions generally offer a pretty significant advantage, leading to real, tangible savings for members across a lot of different account types and services.
That's the clear picture the data paints when it comes to fees, yeah.
All right, let's flip the coin then. Let's look at the other side of the financial equation, interest rates. This is our showdown round 2. How much you earn on your money when you deposit it, and how much you pay when you need to borrow.
Right, earning and borrowing.
And I'm guessing the same basic principle applies here. Credit unions, because they don't need to generate those huge shareholder profits, they can pass better rates along to their members. Is that how it generally works out?
Exactly. That not-for-profit structure, again, it gives them the latitude to offer more competitive rates. So starting on the deposit side, the money you keep in savings accounts, checking accounts, CDs, credit unions generally, offer slightly higher interest rates compared to traditional brick-and-mortar banks, particularly the big national ones.
Okay. Where is this most noticeable, according to the sources? Is it across the board or in specific types of accounts?
The sources seem to indicate it's especially true for time deposits, things like certificates of deposit CDs and money market accounts, or MMAs.
Oh, okay.
Research cited in the materials shows credit unions pretty consistently offering more attractive returns on those specific products compared to the big national banks. It's pretty common to see the huge banks offering really, really low rates on just standard savings accounts, sometimes barely above zero.
Yeah, I've definitely seen that. It can feel like your money is just sitting there basically doing nothing, not even keeping up with inflation.
It really can. Now, there is a nuance here that the sources point out, which is important for, a balanced picture.
Okay, what's that?
While the traditional big banks might lag behind, there's this whole category of online-only banks.
They digital banks.
Exactly. And because they have much lower overhead, costs no expensive branch networks to maintain, they often offer very competitive interest rates on savings and money market accounts. Sometimes they even beat credit unions or the big brick-and-mortar banks. So if maximizing the interest you earn on your deposits is like your absolute #1 top priority, and you're perfectly comfortable doing all while you're banking digitally, then these online banks are definitely a strong competitor you should consider in the mix.
That's a really good point. Were there any instances in the sources where even traditional banks showed better rates on deposits?
Interestingly, yes. One source did note that in some specific recent comparison periods, I think it mentioned Q1 2023 through Q3 2024 banks actually showed slightly higher average returns on interest-bearing checking and savings accounts compared to credit unions.
Oh,
How come? Well, the caveat was huge. These higher rates often came with some pretty significant strings attached,
like what?
like needing to maintain a really high minimum balance, maybe $10,000 or $25,000 constantly, or requiring a large number of debit card transactions every single month, or needing substantial direct deposits hitting the account. So while the advertised rate, the headline rate, might look really good, actually qualifying for it and keeping it could be pretty challenging for a lot of people.
Okay. So read the fine print.
Always read the fine print. Credit unions, while maybe offering slightly lower rates on standard savings sometimes, according to that one source, might have more accessible terms. Easier to qualify, fewer hoops to jump through, especially on their money market accounts and CDs where they often shine.
Okay, so the picture is maybe a little more mixed on the deposit side than on fees. Online banks are a big factor now for rates, but credit unions often seem to have an edge on CDs and money markets and maybe have easier terms on their interest-bearing accounts overall.
That seems like a fair summary of what the sources suggested, yeah.
All right, now let's talk about borrowing money. Loans. This feels like an area where credit unions, based on their whole mission, would really shine.
And the sources largely confirm that feeling. Credit unions tend to offer lower interest rates on a whole range of loans and credit products compared to banks. This is often where that member benefit becomes most financially impactful for people, because paying less interest over the life of a loan can save you serious money.
Give us the data on that. What were some of the specific examples the sources cited? Where do we see the biggest differences?
Auto loans are kind of the classic example that gets highlighted in a lot of this material.
Okay.
The average interest rate on, say, a credit union 5-year new car loan is cited as being significantly lower than what you typically find at a bank. One source put the average credit union rate recently at about 2.58% compared to 3.59% at banks.
Whoa, that's more than a full percentage point difference, 1.01%. How much does that actually save you on a typical car loan? Does it add up?
Oh, it definitely adds up. That 1.01 percentage point difference, it translates into pretty substantial savings. Let's say you get a $30,000 new car loan, financed over 5 years. That seemingly small difference in the interest rate can save you roughly $975 in total interest paid over the entire life of that loan.
$975, just from choosing a credit union over a bank for the loan.
Yep. That's almost like getting 3 full monthly car payments back in your pocket just because you shopped around and potentially chose your lender based on that rate difference.
Wow, that is a really concrete, tangible example of the impact we're talking about. Nearly $1,000 saved on a car loan.
It's very tangible, and the sources indicate this advantage isn't just limited to new car loans. It tends to extend across other borrowing products too.
Like what else?
Credit unions usually offer more competitive rates on credit cards. Often they have lower APRs and fewer fees, although maybe not always the super flashy travel rewards you see on some big bank cards. Also, fixed and adjustable rate mortgages, unsecured fixed rate personal loans, home equity loans, and used car loans as well. The difference was described in some sources as being particularly significant for credit cards and those auto loans we just talked about.
Is there any, regulatory reason why credit unions often have lower rates on these consumer loans? Is there something built into the rules?
Yes, actually. There's a notable point from the sources here. Federal credit unions generally have a legal limit, a statutory cap, on the maximum interest rate they can charge on most consumer loans. Typically, that cap is 18%.
18%.
Correct. Now, there are some exceptions for certain types of short-term, small-dollar loans, the kind designed to be an alternative to predatory payday loans, where the rate can go up to 28%. But for standard consumer loans, that 18% cap offers a layer of protection for borrowers against really excessively high interest rates that you might potentially encounter from some other types of lenders in the banking sector. It kind of reinforces that consumer-friendly lending model.
Interesting. Okay, so besides just the interest rate itself, did the sources suggest that credit unions might be a bit more flexible when it comes to actually approving loans?
They did touch on that, yeah. Because of that member-focused mission, and often because decisions might be made more locally, especially at smaller credit unions, they may offer more personalized and flexible loan options compared to the often very standardized, automated underwriting processes you find at big banks.
So if my credit isn't perfect, but I have a history with the credit union.
Exactly. Or if you have specific circumstances that maybe a computer algorithm wouldn't understand, a credit union might be more willing to look at the whole picture and work with you to find a solution that fits your needs, whereas a big bank might just rely strictly on the credit score and automated rules. Now, this isn't a guarantee, of course, but the structure itself allows for that potential flexibility.
Okay, so summing up this round, across the board, fees and borrowing rates generally seem to lean towards credit unions offering better terms for the consumer based on the data in these sources. And the savings, especially on loans, can be really quite substantial over time.
That's the strong conclusion you draw from the sources when you look purely at the cost side of things, yeah. But, finances aren't just about rates and fees. They're also about how easily you can actually access and manage your money day to day.
Right. Convenience matters.
It absolutely does. So let's move on to Showdown Round 3, access and convenience. This covers things like branches, ATMs, and, of course, technology.
Okay. And this feels like an area where the big banks have traditionally had the advantage, right? With their huge physical footprints, branches on every corner, ATMs everywhere.
Historically, that was definitely the case. And, to some extent, it's still true if you're just counting the number of proprietary branches and ATMs, the ones owned by that specific institution. The huge national banks like Chase or Bank of America, they have these vast networks. One source cited Chase having over 4,700 branches across the country. So if having a physical branch of your specific bank available in pretty much any major city you happen to visit is your absolute top priority, well, then a large national bank might seem like the obvious winner there.
Makes sense.
Credit unions, because they're usually more rooted in a specific community or field of membership, generally have fewer branches of their own. And those branches are often concentrated in a particular geographic region.
So for someone who travels a lot for work, maybe, and still relies on going into a branch sometimes for certain things, that could be a pretty significant drawback for credit unions, couldn't it?
It could be, yes. But, and this is a big but, credit unions have actually been very clever and effective in addressing this potential disadvantage. They've done it through cooperation.
Cooperation.
Yeah, this is really a hallmark of the whole credit union movement, leveraging their cooperative structure to offer shared resources that benefit all their members.
Okay, how do they do that? How do they possibly compete with thousands and thousands of bank branches and ATMs owned by just one company?
Well, they participate in these large cooperative networks. Let's start with ATMs. Many credit unions are part of huge nationwide ATM networks. You might have heard of names like Allpoint or the Co-op ATM network, maybe Plus.
I think I've seen those logos.
Right. These networks essentially combine the ATMs from thousands of participating credit unions and sometimes even ATMs located in retailers like certain convenience stores or supermarkets. And the result is that members get surcharge-free access, meaning no fee from the ATM owner, to literally tens of thousands of ATMs all across the country and sometimes even internationally.
Wow, so even if my local credit union only has, say, 5 ATMs of its own, my ATM card might work without a fee at an ATM down the street that actually belongs to a total different credit union or is inside a store.
Exactly. As long as they're both part of the same network, like Allpoint or Co-op, it instantly expands your fee-free ATM access dramatically.
That is a really smart way to level the playing field on ATM access.
Okay, what about in-person services then? Can I walk into another credit union branch if I'm out of town and need help?
Yes, you often can. That's covered by something called the KOP Shared Branch Network.
Shared Branch Network. Oh.
Yeah, this is another massive cooperative effort. The KOP Shared Branch Network includes over 5,000 participating credit union branches all across the U.S. And members of any participating credit union can walk into any participating shared branch and perform many common everyday transactions.
Look at what kind of transactions?
Things like making deposits, withdrawing cash, transferring funds between accounts, making loan payments, cashing checks, even getting account balances or history. You just need to show your home credit union ID and account number. It's almost like being at your own branch for those routine things.
That is incredibly powerful. So it essentially gives a member of a smaller local credit union access to a nationwide network of thousands of physical locations where they can do basic banking. Exactly. It really levels the playing field significantly when it comes to physical access for those essential routine transactions. Now, you probably can't say, open a brand new account or apply for a complex loan at a shared branch. You'd likely need to deal with your home credit union for that. But for most day-to-day banking needs, when you're away from home, it provides a really wide safety net.
Okay, so physical access, while different, isn't necessarily worse thanks to these extensive shared networks. What about digital access then? Mobile apps, online banking. Are credit unions keeping up with the banks on the tech front?
Well, historically, the big banks, with their massive IT budgets and resources, were often quicker to innovate and roll out the newest digital banking features, the fanciest mobile apps, the slickest online platform.
Yeah, that was the perception.
And the sources we looked at do acknowledge that credit unions, generally being smaller institutions, have sometimes lagged a bit in adopting the absolute very latest cutting-edge technology.
Has that gap closed at all recently? Are they catching up?
The sources definitely suggest that the gap has narrowed quite significantly, especially among the larger credit unions, and also because the industry as a whole has invested more heavily in technology platforms that many credit unions can use.
They're competitive now.
Many national and even larger regional credit unions now offer really excellent digital banking options, websites, mobile apps that are absolutely competitive with what banks offer. In fact, customer satisfaction surveys that were cited in the sources often show very similar scores for the quality, reliability, and ease of use of websites and mobile apps between banks and credit unions.
Interesting.
Most credit unions now offer all the essential features you'd expect. Mobile check deposit.
Crucial.
Yeah, online bill pay, transferring money between accounts, sending money to other people, maybe through Zelle integrations, setting up account alerts, using digital wallets like Apple Pay or Google Pay. They've got the core functionality covered.
So while maybe a giant national bank might have an app with every single bell and whistle imaginable, some features you might never even use.
Right.
A typical credit union's app is likely perfectly sufficient, maybe even excellent, for the vast majority of your day-to-day digital banking needs, like checking balances, paying bills, depositing checks.
That really seems to be the takeaway from the sources. You can manage your money effectively through digital channels at most credit unions these days. The convenience difference in terms of digital access might really just come down to whether you absolutely need highly specialized or bleeding-edge features versus just wanting solid, reliable functionality for your everyday banking tasks.
Okay, so summing up this access round, banks definitely have more of their own branches and ATMs. But credit unions compensate really powerfully through these extensive shared networks for both ATMs and basic in-person services. And the digital gap, for core functions anyway, seems to be largely closed.
That's a pretty fair summary, I think. Access is no longer the automatic slam dunk win for banks that it might have been, say, 10 or 15 years ago, mainly because of that cooperative model paying off.
All right, let's move on then to the actual breadth of offerings, the different kinds of services and products available, and also who can actually join these places in the first place. This is our Showdown Round 4.
Right. And this is an area where banks, particularly the larger national and international ones, typically do offer a wider and deeper range of financial products and services, all under one roof.
What kind of additional services are we talking about here, beyond the basics like checking and savings?
Well, beyond the standard checking, savings, loans, and credit cards, which pretty much both banks and credit unions offer, the big banks often provide a much more extensive menu.
Such as?
This can include a broader array of business banking services. Things like more complex business loans, maybe lines of credit for larger companies, merchant accounts, which are essential for businesses that need to process credit card payments from customers.
Right, for retailers or online businesses.
Exactly, and often more robust payroll processing services. They also frequently have dedicated wealth management divisions. These offer comprehensive investment advice, financial planning, trust services, maybe even private banking services tailored for high net worth individuals.
Okay, so complex financial planning, managing large investments.
Yeah, and international banking services tend to be more extensive at the big banks, too. Things like easily exchanging foreign currency, handling international wire transfers in multiple currencies, letters of credit for international trade. That's usually more in the wheelhouse of a large bank.
So if you're, say, a business owner who needs a lot of those integrated financial services, or maybe someone with really complex investment and wealth management needs, a large bank might just be a more convenient one-stop shop for all of that.
Potentially, yes. That's what the sources suggest. They note that credit unions generally have fewer of these specialized services available by comparison. However, they also sometimes emphasize that credit unions might still be able to assist with some of these needs, maybe on a case-by-case basis, leveraging that member focus to find personalized or flexible solutions. But if you need really specialized, high volume, or highly complex financial services, the big banks are just more likely to have established departments, systems, and expertise already in place for them.
But for most individuals.
Right. For individuals who primarily just need standard banking products, a
Mhm.
checking account, a savings account, maybe an auto loan, a mortgage, a credit card, a personal loan, the somewhat narrower range of services at a credit union might not be an issue at all. They cover the basics very well.
Okay. Now, a really critical point you brought up earlier, and it ties directly into accessing any of these services, is membership. This seems like maybe the single biggest hurdle or barrier to entry for someone thinking about a credit union.
Absolutely. This is a fundamental difference. Unlike banks, which are generally open to pretty much anyone who can meet the basic account opening requirements like having proper ID and maybe an initial deposit.
Yeah, pretty much anyone can walk into a bank.
Right. Credit unions, however, have specific criteria you have to meet to join. You can't just walk into any credit union off the street and open an account. You have to be eligible based on what they call their field of membership.
Field of membership.
Mhm.
What determines that? What defines who can join?
It really varies quite a bit depending on the specific credit union's charter, which is like their license to operate.
Yeah.
But common fields of membership usually fall into a few categories.
Like what?
Okay, first is community-based. This means you might be eligible if you live, work, worship, or maybe attend school within a specific geographic area that could be a county, a group of counties, sometimes even just a specific city or neighborhood.
Got it. Local residents.
Then there's employer-based. This is very common. You might be eligible if you're an employee or sometimes a retiree of a specific company, a particular organization, or maybe a government entity. Think about credit unions for airline employees or hospital staff or federal government workers. Navy Federal Credit Union is a huge, well-known example for military personnel and their families. Boeing Employees Credit Union is another big one tied to an employer.
Okay, makes sense. What else?
You also have association-based membership. This means eligibility comes from being a member of a specific association, maybe a church, a union, an alumni group, or some other kind of organization. Sometimes the pathway to membership for people who don't otherwise qualify is simply joining a related nonprofit organization, often for a small donation or fee, maybe $5 or $25.
So sometimes you can join an affiliated group to get in.
Yes. That's become a way for some credit unions to broaden their reach. And finally, there's family ties. If a close family member, like a spouse, parent, child, sibling, sometimes even grandparent or household member, is already a member of a particular credit union, you might be eligible to join based solely on that relationship, regardless of where you live or work yourself.
Okay, so you really, really have to check the specific eligibility requirements for any credit union you're interested in before you even get excited about their potentially lower fees or better loan rates.
It's absolutely the first step you have to take with a credit union. This is the trade-off, you could say, for that member-owned cooperative model access is restricted to those who fit within that defined field of membership.
Right.
Now, it is worth noting that many credit unions, especially the larger national ones, have worked over the years to broaden their fields of membership significantly. They might have adopted a wider community charter or partnered with more easily accessible associations precisely to make it easier for more people to qualify. But you still have to check. The best way is usually to visit the credit union's website or just call them up and ask about eligibility.
That is such a key practical difference.
Mm.
With a bank, eligibility is usually just about having the money and ID to open the account. With a credit union, there's this extra layer you have to clear based on who you are or where you belong.
Precisely. It's the barrier, if you will, that preserves the cooperative nature, that sense of a common bond among members.
Okay, let's shift focus now to something absolutely fundamental, non-negotiable really, for any financial institution. Safety and security. This is our showdown round 5, and honestly, it's probably the most important thing for just basic peace of mind.
Couldn't agree more.
So the big question, are credit unions safer than banks? Or vice versa? Is my money protected equally?
This is an area where the sources offer really great clarity and, frankly, a lot of reassurance. The simple answer when it comes to your deposits is that both banks and credit unions are incredibly safe places to keep your money. And that's because they are backed by very robust federal insurance systems.
Okay. Federal insurance, how does that work? And are the systems the same for banks and credit unions?
They're run by two separate government agencies, but they function almost identically. Banks are insured by the Federal Deposit Insurance Corporation, that's the FDIC. You probably see that logo all the time.
Yep, FDIC insured.
Credit unions are insured by the National Credit Union Administration, the NCUA. Now, crucially, even though they are separate agencies, they provide the exact same level of protection for your deposits.
And what is that level of protection? How much is covered?
Both the FDIC and the NCUA insure deposits up to $250,000 per depositor, per insured institution for each account ownership category.
Okay, $250,000. Let's break that down a little bit. Per depositor, per insured institution, per account ownership category. What does that actually mean in practice for someone?
Okay, sure. Per depositor, per insured institution is pretty straightforward. It means if you have money spread across multiple insured places, say, you have accounts at Bank A and also at Credit Union B, that $250,000 limit applies separately to your eligible funds at Bank A and separately to your eligible funds at Credit Union B.
Got it. So having accounts at different places gives you more total coverage.
Correct. Now, per account ownership category is where it gets a little more detailed, but it's actually designed to allow you to insure more than $250,000 even at a single bank or credit union, provided your funds are held in different ways, different categories of ownership.
How does that work?
Okay, for example, let's say you have an individual checking account and an individual savings account just in your name at the same bank. Both of those fall into the single account ownership category. So your total funds across both of those single name accounts combined are insured up to that $250,000 limit.
Right. So if I have $150,000 in checking and $100,000 in savings, both just in my name, that's $250,000 total, and it's all covered. What if I have more in those accounts?
If you had, say, $300,000 total in those individual accounts, then $250,000 would be insured by the FDIC or NCUA, and the remaining $50,000 would technically be uninsured.
Okay.
However, let's say you also have a joint checking account with your spouse at the same institution. That joint account is considered a separate joint account ownership category, and funds in joint accounts are insured up to $250,000 per co-owner.
Per owner, so for a couple.
Exactly. For a joint account with two owners, like a married couple, that account could be insured up to $500,000. Two owners, x $250,000 each.
Wow, okay.
And then you add in other categories like certain retirement accounts, like IRAs held as deposits, and certain trust accounts, which are also treated as separate ownership categories, each with their own $250,000 limit per beneficiary in some cases. Well, it means depositors can actually protect well over the basic $250,000 limit at a single institution just by structuring their accounts across these different ownership categories correctly.
That's really helpful to know. So it sounds like for the vast majority of individuals and families, their everyday deposits, checking, savings, CDs, are going to be fully protected up to that $250,000 limit by federal insurance, regardless of whether they choose a bank or a credit union.
That is absolutely the critical takeaway from the sources on safety. The safety of your deposited funds within those limits and categories is essentially equivalent whether you choose an FDIC-insured bank or an NCUA-insured credit union. Both insurance funds are backed by the full faith and credit of the U.S. government. This insurance system was put in place decades ago, partly in response to the bank runs during the Great Depression, and then strengthened over time precisely to maintain public confidence in our financial system.
What types of accounts are typically covered by this insurance again, just to be clear?
Generally, it covers your bread and butter deposit accounts. Checking accounts, savings accounts, money market deposit account, not money market mutual funds, that's different, certificates of deposit, or CDs, and also certain retirement accounts that are structured as deposits, like IRA CDs or IRA savings accounts. Certain trust accounts are also covered depending on how they're set up.
Okay. And just as importantly, what is not covered? This is crucial for people to understand.
Absolutely crucial. Neither FDIC nor NCUA insurance covers investment products, period.
So stocks, bonds.
Stocks, bonds, mutual funds, annuities, life insurance policies, U.S. Treasury securities, none of those are covered. Even if you happen to purchase them through a brokerage service that's located inside your bank or credit union branch, investments can lose value. That's market risk, and that risk is not insured by the government.
Got it. Investments are separate. What else isn't covered?
Also, the contents of a safe deposit box are not covered by FDIC or NCUA insurance. The box is just a storage space you rent. The institution isn't insuring the value of what you put inside it. You'd need separate private insurance for valuable items stored there.
Good distinction. So the insurance protects your cash deposits, basically, but not the value of your investments or physical items you store there. Is this federal insurance mandatory for every single bank and credit union?
That's a good question. Our sources note that while maybe not every single type of financial institution in the country is strictly required by law to have this federal insurance, for example, there might be some very small state-chartered institutions that technically could operate without it, though that's extremely rare and generally not advisable.
Right.
In practice, virtually all competitive banks choose to have FDIC insurance, and virtually all state-chartered credit unions choose to have NCUA insurance. Federal credit unions are required to. Why? Because depositors demand it.
Nobody would put their money somewhere uninsured.
Exactly. An uninsured bank or credit union simply wouldn't be viable in today's market. People expect and rely on that protection. The key thing for you as a consumer is to always verify that your chosen institution is federally insured. Just look for the official FDIC or NCUA logo. It should be prominently displayed on their website, on the door, at the teller windows.
Okay, so bottom line on safety. Peace of mind regarding the safety of your deposit should be the same. Identical $250,000 limit per depositor, per institution, per ownership category, whether it's an FDIC bank or an NCUA credit union, assuming you've verified they are indeed insured.
That is the definitive point on the safety of your deposits. They are equally protected. Full stop.
All right, fantastic. Let's talk now about some of the less quantitative aspects, maybe the more touchy-feely stuff, the overall feel of the institution, the customer service experience, the reputation. This is our showdown, round 6.
Right. And this is an area where credit unions often really emphasize their customer service as being a key differentiator. The common claim, and it aligns with their whole philosophy, is that because they're often smaller on average, and because of that member-owned structure we keep talking about, they offer a more personalized experience. The idea is you're treated as a member, part of the cooperative, rather than just being another account number in a giant system. They tend to highlight their involvement in the local communities they serve and focus on building actual relationships with their members.
That's definitely the narrative you hear a lot. Does the actual data from customer satisfaction surveys back that up universally? Like, are credit unions always rated higher for service across the board?
Well, the sources we looked at present a slightly more nuanced picture here. It's not quite that simple. While credit unions do often score very well on measures like staff courtesy, how helpful the staff is, feeling valued as a customer, some of the large-scale surveys, like the ones from the American Customer Satisfaction Index, ACSI, sometimes show varying results from year to year. Interestingly, regional and community banks often score very highly as well, sometimes even slightly surpassing the average score for credit unions in overall satisfaction categories.
Oh, interesting. So smaller banks can be good too.
Yeah, it seems like size and local focus might play a big role, regardless of the charter type. The big national banks tend to have lower average satisfaction scores, but even that can depend heavily on which specific bank you're talking about and also what service is being rated. For instance, a big bank might get lower scores for in-branch service, but higher scores for its mobile app compared to a smaller institution.
So it's not a straightforward credit unions always have better service story based on the aggregate data. It might actually depend more on the specific institution you choose, whether it's a small local bank versus a giant national credit union or vice versa.
That's precisely it. The idea of local decision-making, especially at a smaller credit union, can definitely foster a stronger sense of trust and maybe lead to faster resolution of problems because the people making the decisions might be right there in your town, not in some distant corporate headquarters. That can feel really empowering as a member.
I can see that.
On the other hand, the large banks have huge resources for employee training, standardized procedures, which can lead to a certain level of consistency in service, but maybe that comes at the cost of slower response times sometimes, or less flexibility compared to a local credit union manager who actually knows you.
Right.
So it really seems to be about finding an institution, whether it's a bank or a credit union, that aligns with your personal preferred style of interaction and one that has a genuinely good reputation based on maybe online reviews or word of mouth in your community.
So that personal touch might be more reliably found at smaller, more local institutions in general. regardless of whether they happen to be structured as a bank or a credit union, even though the credit union model kind of incentivizes it more broadly.
That seems to be a reasonable conclusion when you try to synthesize the survey data with the underlying structural differences. The potential for a deeper, more personal relationship might inherently be higher at a credit union because of that membership model, but you can certainly find excellent personalized service at banks too, especially the smaller community banks.
Okay, wow. We have covered a ton of ground here. We've looked at the fundamental differences in ownership and mission. We've dug into fees, interest rates, access through branches, ATMs, and tech. We've talked about the range of services offered and who can join. We've covered the critical safety aspect, and now the customer service styles. That's a lot of information.
It is. There are many facets to this comparison.
So, given all of this, how does someone actually go about making the choice? Is there a clear winner that emerges from all this?
You know, the clearest takeaway from trying to synthesize all these different points from the sources is that there really is no single better institution that's right for absolutely everyone.
Okay.
The best choice really depends entirely on you, on your specific financial needs, your priorities, your banking habits, what you personally value most in a financial partner. It really requires weighing the various trade-offs we've discussed based on what matters most in your situation.
Okay, so let's play that out. What if my number one priority is just saving money?
Yeah.
Lower fees, better rates, above all else.
Okay. If your absolute top priority is minimizing every possible fee and getting the most favorable interest rates you can find, especially on loans like car loans and mortgages, and maybe getting higher rates on time deposits like CDs and money market accounts, then the sources strongly suggest that a credit union is likely to offer you better terms overall. If, and this is the big if, you are eligible for membership at a credit union that meets your needs, you'd absolutely need to verify your eligibility first. And then you'd want to make sure their access options, things like the shared networks we talked about, their digital banking tools are sufficient for how you manage your money. In that scenario where cost savings are paramount, you might be willing to accept maybe a slightly less expensive range of highly specialized services or potentially digital features that aren't quite as bleeding edge as the very largest banks might offer.
Okay, that makes sense. What about the flip side? What if I need a really wide variety of services? Maybe I own a business, or I absolutely need physical branch access basically anywhere I travel in the country.
Right. If you need that broad suite of services, maybe you need integrated personal and business banking or sophisticated wealth management advice or extensive international banking capabilities. Or if having a massive proprietary national network of physical branches and ATMs belonging to just one institution is absolutely essential for your lifestyle or business, well, then a large national bank is probably going to be a more suitable choice for you.
And the trade-off there?
The trade-off there, according to what we've seen in the sources, is that you should generally expect to pay potentially higher fees for services and likely receive less favorable interest rates on both your deposits and your loans compared to what a good credit union might offer. You're essentially paying a premium, in a sense, for that massive scale, that nationwide convenience, and that breadth of specialized services.
It really, really sounds like it just boils down to knowing your own priorities.
It absolutely does. The sources kind of implicitly suggest you should ask yourself some key questions, like how important is it to me to minimize every single possible fee? Am I planning to take out a major loan, car, mortgage, personal in the near future, where even a small difference in interest rate could save me hundreds or thousands of dollars? How often do I actually need to walk into a physical branch versus managing things online or through an app? Can I get by just fine using shared ATM and branch networks if needed? Do I require specialized services like business banking, merchant processing, or in-depth investment advice? What level of importance do I personally place on customer service? Do I want to feel like a valued member? Or am I okay just being a customer number as long as things work efficiently?
And the big one.
And the absolute fundamental one for credit unions. Can I even join a credit union that seems like a good fit for me based on their field of membership?
Yeah, that last point about eligibility, it's just non-negotiable for a credit union, isn't it?
Exactly. You might research and find a credit union that looks absolutely perfect on paper, great rates, low fees, fantastic reviews. But if you don't meet their specific membership requirements based on where you live, where you work, or groups you belong to, then unfortunately, it's just not an option for you. It's definitely worth spending some time exploring which credit unions you are actually eligible for in your area or through your affiliations.
This has been incredibly illuminating, really pulling back the curtain on those fundamental differences and showing exactly how they translate into the things we care about: fees, rates, access, service. We've seen pretty clearly that banks and credit unions operate on fundamentally different models, driven by different core purposes, shareholder profit versus member benefit.
Right.
And the conclusion seems to be that neither one is inherently better across the board.
Mm.
They just offer different packages, different value propositions.
That's exactly what the sources point towards. Your ideal financial institution is a really personal decision. It involves weighing that concrete data we talked about, the numbers on fees and rates, against your own needs for access, the specific services you require, and the kind of customer service experience you desire. The choice really rests on understanding your own financial habits and priorities, and then finding the institution, bank, or credit union whose structure and offerings align best with those personal needs.
And as you consider where your money lives, where you do your banking, maybe there's a final provocative thought that goes right back to that core difference we started with: ownership and mission.
Mm-hmm.
Beyond just comparing the numbers on the rate sheet or the fee schedule, maybe ask yourself this: how does the very structure, the fundamental purpose of this institution align with my own values and my long-term financial goals?
That's a great point. That connection or lack thereof between the institution's mission and your own financial journey, that might actually be the most important factor of all in the long run. Are you just looking for a place to process transactions efficiently? Or are you looking for more of a financial partner? Who is this institution ultimately working for?
That is a really powerful question to sit with. Knowing who owns the place, and therefore what their primary driver is, profit or member service, it really tells you a lot about how you can expect to be treated and how your money is likely going to be handled over time.
It certainly frames the relationship differently.
Well, that brings us to the end of this deep dive. Hopefully, this comparison, drawing on all those sources you shared, gives everyone listening the clarity and the key insights they need to make a truly informed decision about where they bank their money.
We certainly hope so. Understanding these differences really empowers you to choose the financial institution that truly serves your best interests, whatever those interests may be.